Unlock the high returns of the expanding venture capital world right here on the Emerging Managers Podcast.
Hello, everybody. My name is Scott Kelly. I am the founder and CEO of Black Dog Venture Partners and the host of the Emerging Managers Podcast. And I'm really excited to introduce Erik Huberman from Hawke Media, Hawke Ventures, and what we'll be talking about today, the Hawke Deal Room. So, Erik, welcome.
Yeah, thank you for having me.
So, Erik, before we get started into the Deal Room, share a little bit about your background, because you've had a pretty illustrious career on the media side, on the venture side. So why don't you share a little bit of perspective about your success up to this point? Then we kind of jump into the opportunity with the Hawke Deal Room.
Sure, and I got to say it because I'm a marketer at heart. It's the Hawke Deal Network, not the Hawke Deal Room.
My apologies.
But yeah, background is e-commerce. Built and sold a couple e-commerce companies. This is over a decade ago. And about 12 years ago, started advising and consulting for a bunch of different brands on how to drive revenue growth using marketing and how to actually leverage these marketing channels that were popping up. And digital was still pretty new. I thankfully had some early success in it. And so ended up working with some big brands like Verizon, Red Bull, HP, as well as a lot of startups and some growth stage companies, everything in between. And found that there still is a huge problem in the marketing landscape. There's actually 90,000 marketing agencies in the US. And I would put my stake in the ground that about 99% of them have no idea what they're doing. And the few that are good generally go up market and only want to work with the Fortune 2000 and kind of get a little pretentious about it. And so the idea of being the best at what we do, but also easy to work with, became kind of the calling card and mission of Hawke Media. And the idea is we could go into a brand, identify the holes in their marketing side of things, and then spin up the team exactly what they need, when they need it, and ebb and flow as those needs change. And so, again, started almost a dozen years ago. We've now got 250 full-time people, company still bootstrapped and independent. We've worked with almost 6,000 brands at this point. And yeah, company continues to grow and thrive and do really well. And so a year into that, my theory about building this business, and I was in my late 20s, was I will cash flow the agency and put that money into real estate. And I came from a real estate family. I like the asset as an investment class. And so that was my plan. And then a year in, a friend of mine reached out and said, "Hey, we're pivoting our company into e-commerce and we want you to invest." And I was like, "That's cool, but I'm not investing in startups. I spend all my time in startups and I'm not going to do that." And he goes, No, I'm not asking you. I'm telling you it can be a small check, but you're in. So I wrote that check because I appreciated how pushy he was. And that company became a multi-billion-dollar company called FabFitFun. So then realized maybe I shouldn't be so stubborn about this and opened my mind up a little bit, started writing small checks and doing some angel investing. And after 3 years, we had about an 11x return. And I had hired someone to help me manage that portfolio, as well as we were doing some sweat equity deals with Hawke Media. And he came to me and said, "Hey, your sweat equity deals are not doing very well, because it turns out when someone's willing to hand you just a giant chunk of their company to do marketing, they probably don't value their own company very much. But these checks you're writing are doing really well. So we should do more of this." And as a guy that did not have unlimited capital, we talked about how we could write bigger checks and decided to raise our first fund. So we raised our first fund starting in mid 2019, closed it in mid 2021. That fund has 3 to 4x on paper returns so far, in 4 to 6 years, depending on how you look at it. And so that's done really well. We then closed our second fund in February of last year. That's already had significant markup as well. And the thesis of the funds became mostly where we early on, it was, let's spend 70% of our money on marketing tech, e-commerce tech, commerce enablement, all the tools we use for our clients. Because currently we have 550 active clients. We sign between 30 and 50 a month at Hawke Media. If we find tools that we can use, we can invest in them and now be a market maker for them. And then let's do the minority of investments into consumer deals, some of which have done very well as well. We leaned more and more into the tech side because of our ability to sort of step on the scale for these companies. And so, yeah, fast forward now, we've done over 60 investments out of the fund, over 100 investments, including our angel investments. Fund 2, again, is doing well at this point. Will be fully deployed probably by mid next year. And so brings us to the Hawke Deal Network and how that came to be. The fund's mandate is early stage marketing tech and e-commerce tech with a very rare investment into an early stage consumer brand. That's what our LPs expect, and that's what they committed 10-year capital to. So we're committed to that. It's doing well, but there's a lot of deal flow we get outside of that are great companies that just don't fit the fund mandate. So it could be a later stage consumer brand that we've worked with, that we know well. and we want to invest in, but it's too late for the fund and we wouldn't be able to get enough ownership. Or even an investment we've made, which will be an SPV we're probably announcing early next week in one of our most popular portfolio companies that we can't put more of the fund into it. It's already over allocated into that deal. So, but we have an allocation. So let's go, surface it to our LPs as well as our network. And so this deal flow and this ability to generate deal flow, we've had no shortage of. I mean, our sales team talks to over 400 qualified companies a month, about 1,000 different companies a month. Plus, every company raising in our space that knows about us reaches out, because between all the major funds that we co-invest in, I mean, name a big venture fund, we've probably co-invested with them that want us to be a part of those because we are a strategic advantage. A bunch of our clients that we see really good traction with that want to raise money, et cetera, they all want us to be a partner, thankfully. So we have no shortage of great deals coming across our desk. And now we have the ability to look at them deal by deal and actually do them. And that's where the Hawke Deal Network came in. So we just closed our first deal with Pathwater, which is the aluminum bottled water that you'll see all over airports. And they have partnerships with Hello Kitty and SpongeBob, and they're the Four Seasons water. It's a really cool play that frankly speaks to my marketing side as well. And they've done really well. They're growing really fast, and a lot of upside, and some inside baseball there that is going on, and that we're really excited about it. And we actually did their marketing launch as well originally 6 years ago. So that's been a really fun one. Again, we have another couple already in the hopper that we're running diligence on right now that we're pretty sure we're going to launch. One probably next week and another one a few weeks later.
So talked about your unfair advantage. You obviously, with all these companies you're talking to and all these companies you've done marketing for, how does that provide you an unfair advantage in picking the winners, versus everybody else?
There's a few ways, and I just put the link in the chat too for anyone. Anyone can sign up for it. Like, our goal there is to really democratize what we're doing on the investing side. So the unfair advantage comes in a few forms. One is obviously on the technology side. If we find a piece of marketing tech, our diligence is second to none because we're actually a customer. So we can go and use the products, use it on clients, see that it works, see that it becomes mission critical. And then that becomes something we want to invest in. Then if we do invest, we usually try to build a service around it so that our sales team becomes the software sales team. So a good example of that is Postscript that we invested in. We launched SMS marketing using Postscript, and then everyone we sign on to SMS marketing, we generally refer to that. We've sent them hundreds of customers and created tens of millions of dollars in enterprise value for that company. And we invested when the whole company was only worth 15. And now they're worth, this is where it gets debatable, but I'd argue that they're worth probably not quite, but close to $2 billion now. And so they haven't raised money since early 22. So there's no real valuation on the company, but that's part of the beauty of it. They're growing really fast and don't need any outside capital anymore. So we're just watching our stake in that grow. And so those are two advantages. And then I'd say another one is the ability to get deal flow. Again, we've put our name out there. We drink our own punch. We market the hell out of ourselves. And so everybody that's trying to raise money that would see us as a good partner comes to us. And generally, if we can be a good partner, that's what we want to invest in. So if we're an advantage to the company and they see that, it also sometimes gets us preferential terms if there's a reason for that. Again, gets us the access that most don't have. And we also, a lot of times, bigger funds carve out, they take a little bit less of a stake to get us in because they want the partner in. So we get a crazy amount of deal access that has been really solid at times. And then it's also just we have our pulse on the industry. We know we have a marketing platform that we built called Hawke AI. We're watching 6,000 companies, marketing, media, and revenue data running through it in real time. We know who's doing well, who's not, what that looks like. So when we do diligence on a company, we have a pretty good idea of what it should be doing and what it is. And that goes both ways. Sometimes that's, they're doing everything right and the numbers look great. And so this could be, they're a really solid team, or their numbers are great, but they're not doing a lot right. And they have a lot of opportunity. And now we can actually go in and help them do even better because they're missing so much and even doing well in spite of themselves. Those two situations both can be good in different ways. I'd say the one situation, or the situation you don't want, is either way, their numbers aren't doing well. Even if they're not doing everything right, but the company's not doing well, not interested. If they're doing everything right and the company's not doing well, that's a really bad sign. So that helps as well.
That's awesome. So obviously you're on the cutting edge and you see all these companies. What are the most exciting opportunities you see in commerce, marketing, ad tech right now?
I mean, the best investment we've made recently, but before the one we'll probably do next week, we invested in a company called Gumshoe.ai that they are basically a platform to help you optimize to show up in all the LLMs. So if someone's searching or asking ChatGPT, what's the best marketing agency in the US? Like, we want Hawke Media to show up. And it turns out because I've had direct phone calls about it, we are showing up. Now, all these platforms are very individualized. So it shows up for certain people and not others, because I got cocky about it and had I'm like, yeah, go ask ChatGPT who to work with. And 3 times in a row, it said Hawke Media. I was like, there you go, which was a really fun sales tool. Or the 4th time when we didn't show up and I had egg on my face, I'm like, well, that's not good. All right, back to the drawing board. But yeah, we're working on that and it's going really well. It's become obviously everyone's interest. And I think it's rational in terms of like more and more people are going to these AI tools to, search for solutions. And to show up there is really important. So that's been a good one. And yeah, again, we'll have more info on the one next week, but still as it relates to AI, but in a very practical, commerce-driven way that I really like. And that's the idea, is like in a time like now when it comes to technology, assessing what's hype and what's real is really important. One thing, we've been really slow to invest in certain AI tools because it's so easy to spin up software now that I equate it in a very basic way. It's like starting a t-shirt company. Like anyone can build a t-shirt company. I promise everyone on this call could go start a t-shirt brand, get a cool design, put it on a t-shirt, done. You've got a brand. Software has actually become not quite that basic, but it's getting pretty basic. And so our focus now is much more on go-to-market strategy and sales velocity, strategic partnerships, a founder that knows how to get this thing going. And so how do you build that moat from a marketing standpoint and a sales standpoint, not necessarily from a great piece of software standpoint? So that's been a pivot in our thesis over the past year or so as Cursor and Lovable and all these AI development tools have come up. Just having great tech is kind of table stakes. So that has changed a lot. And so the way we're looking at things now is, thankfully, we are one of those strategic advantages. So it fell into our lap in the way of like, we actually spent a few hours as a venture team just talking through what's changed, what's new. And this is frankly what we came out with was like, yeah, we all agree, and we've all had successful tech investments, that it's become much more like starting a fashion brand in the thankfully we have a lot of experience in that, in the way of like, it's much more brand driven, marketing driven, customer driven than it is tech driven these days. Because again, that technology is pretty, it has a low barrier to entry. And so because of that, really driving into that piece of the business and how they're doing that. And it's what's fun in a way is so many technologists are so bad at it. It actually does create a huge advantage when you find a great technologist that is a great marketer. Heatmap.com is a good example of this. Dylan, the founder, is a rock star marketer and a great conversion rate optimization person and known for it, has a huge following. This is one of our investments. And so he built a great new heat mapping tool that allows you to optimize your website better and do a lot of other things. And it's been off to the races because he knows how to go to market with it. He has a great audience. He has a built-in audience that's taking it there, and he understands marketing and brand. So that's become a much more important part of this. And then big strategic partnerships, big distribution partnerships is a big one. So yeah, great that you built a great software, but if you don't have a great go-to-market partner, and again, the one coming, if you all sign up, you'll see it, but the one coming next week is an example of that, where they have massive distribution partners that allow it to be the one that wins. Because without that, the actual technology, someone can replicate most technologies in a weekend these days. So don't tell me that you built great tech and you don't have any of those strategies, because if not, someone else is going to build it. They're going to go to market faster and you're going to lose.
So yeah, I'm glad you mentioned that because, and you mentioned Lovable, a couple moments ago. How is the fact that companies like Lovable can scale to 100 million ARR in such rapid time? How's that affecting how you're handling it from a marketing standpoint and how you handle it from an investment standpoint?
Yeah, I mean, it's great marketing and a great tool. But to be real, there's other tools like Lovable, but Lovable did great marketing. Like that's a great example of like they did it right. And that's where it's just a different landscape than it was even 2 years ago when it comes to investing in tech and investing in companies. Because I mean, Lovable's, I don't think they're a year old yet. And I have friends that did their pre-seed round and were telling me how excited they were about it in May. And I was like, that sounds really cool. Again, this is where a line I always have to repeat to myself. Barry Diller said, I've never lost money on a deal I didn't do.
Right.
We passed on a lot of deals that have gone really well. Not that we had Lovable, but we've had other deals that we've definitely passed on, but we stick in our lane. And there's been, thankfully as an angel investor, I've blown enough of my own money investing in things I don't understand that I'm not going to do that with other people's money.
Let's spend a little time on the Hawk Deal Network. Talk about, why you put this together and maybe mechanically, how people can participate and, what they would look see once they get involved in the Deal Network.
Yeah. So highlight a little bit, but I think to bring it home, the reason we launched it was our fund is committed to pre-seed and seed marketing tech, e-commerce tech, and again, with a rare consumer brand. So everything later stage consumer, later stage tech that's too big for us to invest in, even our own deals that are progressing there, as well as things that are outside both of those that we go, this is just a great company and a great deal. We know the founders and we have, again, a crazy founder network that it's like, I want to put money in this. And I've done enough angel investing, but I've always looked at that and gone like, I bet if I called a bunch of friends, they don't want to do this with me, but I don't have a vehicle to do that. So, an example of that is Mosh, which is Patrick Schwarzenegger and Maria Shriver's brain bar company.
Mm-hmm.
It's crushing it. Then go figure Patrick gets White Lotus, becomes a phenomenon, and now it's skyrocketed. And they're going to raise another round soon. And so we're looking at that as a good example. Like a lot of this is just, we have all this access, we have all this opportunity. Why not bring this to our network, our friends, our audience, et cetera, and work with them on it and be able to, take bigger slugs of these deals. And so that's the why. The why is we have this, it's one of those funny things where we have this opportunity and now we want to bring, actually be able to take advantage of it aside from me just writing my own personal check into it. So that's where it comes from. In terms of what you experience, again, I put the link in chat. It's basically a newsletter. Like we're going to, you sign up, confirm you're accredited investor. And at the point you actually want to make an investment, you have to go through all the legalese and AngelList because that's what we're using for it. And then it's deal by deal. We're going to share deals as regular as we see a good deal. Could be every week, could be not for months. Like it just depends on how often we run into a good deal. The nice thing is because it's not committed capital, there's no urgency. There's no rush to deploy. It's just if there's a deal because I'm going to put money in all these, like if there's a deal that we're excited about, then let's go do it and let's open it up to our network. So it's completely non-committal. There is no commitment. If you want to just be, watch and see what we invest in, people can do that. And the goal for us is to be able to go to great companies and be able to raise as much money as they need when we like the company and do it within a day. So it's going to be first come, first. It already is first come, first serve. We had a few people miss out on the last one. We close them quickly. The last one, we had completely closed within a week. And it's just, send it in, get it done, deploy the money, move on to the next one, and then obviously report against it, watch it, see how these go. But the idea and the mission there is really to be able to take full advantage of all the deal flow that we get and actually put the money to work.
So each one of the deals in the deal network are going to be separate SPVs investing in those companies. Is that going to be structured? Okay. We'll take a couple of questions in a minute, but any final thoughts you want to share about the state of venture, the state of marketing today?
Yeah, I think, liquidity's been hard for 3 years for these companies, 3.5. I mean, really, well, since early 22, it's getting better. We're seeing, the nice thing is Hawk Media from the marketing side is kind of the canary in the coal mine both ways. And so we're seeing more and more proactivity from founders. And so I'm starting to see more growth there. And the whole economy is driven by fear and greed. And I think we've been in this cycle of fear where I don't know how long you can talk about a recession coming before it just gets ridiculous, but I think it's been, 5 years of recession talk. And I would argue that I've looked a lot at this data. I've spent a lot of time on this. Mid 22 to early 23 to me was a recession. We had negative GDP growth. The employment numbers were really, I don't want to say they weren't falsified, but they were misleading. Most of the employment growth we saw was part-time growth or part-time jobs taking away from full-time jobs. We had full-time job decline from mid 22 to early 23. So like if you looked at it in more the traditional sense, we had a recession and I think we're now coming out of it. So how I look at this optimistically is I think we're in like 2010 from the GFC. Now what we dealt with in 22 is nothing like 2008, don't get me wrong. But like, I think we're starting to, we've kind of hit late 24, we kind of hit that like, okay, it's not diving. There's still some shakiness, but starting to come back. I think 25, we're seeing some growth. This tariff stuff obviously shook people up and it still is. Even yesterday, the market was all over the place. Today, it's back up. Like it's annoying, but I think what I've seen with founders is we're in year 5 of unprecedented times and they're just kind of sick of using it as an excuse. And so most of the founders that haven't already given up are now the people that are like, I don't want to hear about it anymore. Just move on. We saw that with tariffs where we have, again, marketing over 500 companies. And out of all of them, when the tariffs hit and whatever that was, I think it was February they started talking about it. 4 out of 500 clients actually said anything about it. And the rest were like, yeah, whatever. We're going to have to adjust some, of our supply chain, but like moving on, it's another thing. It's just welcome to running a business. So that all being said, I think we're getting towards an upswing here. And so I'm confident in the next couple of years, we're going to start seeing the exit velocity again, which then brings the money back into it. Investments start picking up. So there's a quote everybody knows that does any investing from Charlie Munger, which is be greedy when others are fearful. Except for when everyone's fearful, people get scared. It's really funny to watch. Like you forget that when it's the time to remember that. For me, I've remembered it and we continue to invest. We never overpay. We just passed on a deal that was like 40 times revenue and it's a great deal, but I'm like that, like you just took away, it probably should be 15 times. So you took away almost 3x my returns right away. Like you just mitigated my upside. I'm not doing that. So we've just stayed disciplined on the way we invest and never got caught up in hype. And because of that, most of our deals have done really well. And like, whenever the next cycle of exits come in, we've got some deals that are doing really well. One of our best investments, I talked to the other day and they're like, listen, we're going to get dinged on valuation right now just because the only guys getting good valuations are the FANG companies and like everyone else is kind of getting dinged. So like, but we don't need the money, so we're not going to do anything right now. And we think in the next year or two, that'll turn around and then we'll start looking. But it's whenever, thankfully the private equity world, the VC world, the public markets, all these finance people, they got to put money to work. So at some point, it's almost a game of chicken both ways where when the market's coming down, founders wait. And then the worst companies have to do something and they end up, making it look like there's this big trough because they had to take money at a bad time. Same thing happens on the upswing. Like funds wait. They're like, we're not going to pay that. We're going to pay that. And then all of a sudden they can't get into any deals because they missed all the good ones and they go, screw it. And then everyone starts paying a lot. I think that swing will come in the next couple years. It's hard to predict. There's no crystal ball, but I think it's been one of the longer slowdowns in a long time when it comes to this kind of investing. And we've already seen the markets at all-time highs. Like we're at this point now where greed will probably start to kick in because so many investors realize they already missed a lot of things.
We'll take a question or two. If you have a question, you can raise your hand in chat, or you can post your question. I'll be happy to answer that for you. So while waiting for that, talk about some of the folks you've co-invested with. Obviously, it's probably been many, but anyone of note that we could talk about today?
Yeah, I mean, Piner Perkins, Sequoia, A16Z, Greycroft, Greylock, Upfront, like any of the big a lot of the big venture funds. I shouldn't say any, but I'm trying to find that sheet, but we have a list somewhere of all the different funds we've invested in, and it's sizable.
Again, the Hawke Deal Network, we're going to be recording, we are recording this, and we're going to be posting this on the Emerging Managers podcast. Erik was one of our first guests several months ago. So I wanted to let everyone know about the Deal Network. And if you want more information, you can go to hawkedealnetwork.com, or you can reach out to me, and I'd be happy to get you in contact with Erik and his folks. So Erik, thanks for being on the show today. Appreciate it.
Thank you all.
And all for joining. Thank you.
Join Scott Kelly, Tracy Hazard, and their high-performing capital fund manager guests next week on the Emerging Managers podcast. Don't miss our upcoming virtual and live VC Fast Pitch and podcast events. For more details, background on our guests, or an application to be our next guest, visit emergingmanagerspodcast.com. Don't miss out on shaping the future of venture capital and entrepreneurship with us by joining our robust community of innovators and investors today.